Things look like they're going from bad to worse for London's IPO market. In 2006, more than $50 billion was raised during initial public offerings. But in 2024?
You can see that it is relatively healthy, and then it just drops off.
Particularly since 2008, we've seen a fall in about 40% of the number of companies listed in the UK.
The first half of 2025 has been the worst for IPOs since 1998, and that sounds terrible.
London falls out of top 20 IPO markets as fundraising slumps 69%.
In the global rankings, the UK is now all the way down here. And this is just one of a string of factors undermining London's more than 300-year-old exchange. A few green shoots have begun to sprout under London's trading floor, but buried beneath a financial malaise decades in the making. This is a story important to ordinary people as well as investors. But just a heads up, it's not a happy one.
It's a shocker, isn't it? It really is.
Before we explain the reasons for London's dearth of them, it's worth a quick primer on what an IPO actually is.
It's when a private company moves to a public market, listing its shares on a stock exchange so the general public, or indeed anyone, can buy shares in that company.
It is a moment where a company can either raise a whole load of funds, or shareholders can also sell a chunk of their shares.
It provides public scrutiny of companies, so it's a fundamentally important key to democratic shareholder capitalism.
It shows that people around the world want to put their money to work in this country, that they trust the country's institutions.
A listed public company will tend to pay, for example, more corporation tax than a private company for all sorts of reasons, but it's very good for the tax infrastructure as well, which of course is vital to our public services infrastructure.
It is also where people invest their cash to grow. It's where some of their pensions are invested.
The City of London stands for business.
The London Stock Exchange and the City of London has been one of the biggest drivers for the UK economy for many years. For centuries, in fact, it was where the world came to trade.
And around the 1800s, it gets its first set of rules.
From the prosaic, to do with settlements and defaults, to the surprising, like a ban on explosive fireworks on the trading floor. Maybe that's why it became a bit of a sleepy affair for 150 years or so, until the 1980s.
Where you have a massive bout of privatisation and deregulation. And that turns the City of London from what was a bit of a staid sort of old boys club,
you know, men are better doing this sort of work,
into a little bit more of a rocking financial centre.
That is, until the point our story really begins, around the 2008 financial crisis.
Which was ultimately a banking bubble and bust. And London and New York were at the heart of that together, and London crashed.
We have had bad years for IPOs. 2003 was bad, 2009 was bad, 1992 was also bad. And they do coincide with economic turmoil, with uncertainty, with financial chaos. And then we get to 2022. Interest rates have got up and everything's changed. And there's just this abyss. There are not the deals coming to the table.
To understand the snowball effect this can trigger, let's think of a stock exchange as a bath, with a reporter in it, because apparently Margot Robbie was busy.
Like all good baths, there are rubber ducks. These are initial public offerings, companies coming to the market. Now, on occasion, you will have companies delisting.
And normally that's okay. They're probably being taken private through mergers and acquisitions.
But the problem is, in recent years, because London listed companies are at bargain basement prices, there has been a load of takeovers.
Over the last 20 years, UK companies have consistently traded at a discount to peers in other developed countries. This line shows that in 2006, it was around 15% compared to the average. But recently, it's been closer to 35%, which fueled the takeovers behind an exodus from the London Stock Exchange. Which brings us to liquidity.
That's how easy it is to buy and sell shares. If liquidity is good, then the bath is warm and full of water. And that means when an investor buys a share, they know they're going to be able to sell it again. And that helps attract companies to the market. But if liquidity starts to drain out of the market, and the bath starts to lose its water, that looks less attractive.
So companies start to look elsewhere. And what do you know? New York looks pretty good. There's more liquidity. It's easy to trade. There's a ton of investment.
Meaning the London Stock Exchange continues to shrink.
One of the things that has made the UK market so incredibly lackluster over the last couple of decades has been the exodus of domestic investors from our own market. So that's been our pension funds, our wealth managers, and our ordinary retail investors.
Steadily over the last 10 years, the US stock market as a proportion of global equities has risen to something like 70%, with Japan coming in second at around 5% and the UK third, believe it or not, at 3.5%.
And then you've got the London Stock Exchange missing out on some really key IPOs.
The Chinese clothing retailer Shein was meant to list in London, but then couldn't.
But the biggest of all was Arm Holdings, the British company whose semiconductor designs underpin almost every mobile device on the planet.
It used to be listed in London. It got taken private, and when they were looking to list it again, they chose New York.
They simply found it more appealing to list on the NASDAQ.
One of the reasons why people might choose to list in the US, and it's partly about valuation. You take your company, you list it in the US, and immediately you will get an uplift in the valuation of your shares.
A lot of it will depend directly on the company itself, on their own dynamics, on whether they have good future growth prospects.
But if the valuation does jump,
each share will be worth more. And if each share is worth more, then managers' remuneration will automatically be higher, given that most senior management in big listed companies are on some kind of pay deal that is connected to share price.
Executives in the UK are generally paid significantly less than their peers in the US. And when they do move abroad, their pay does tend to go up. And that is seen as key to retaining talent.
and they are moving.
Shareholders of the tour operator TUI have approved ditching its secondary listing in the UK in favour of focusing on Frankfurt.
Wise plans to transfer its primary listing from the LSE to New York. A real blow to London then, perhaps.
We saw Flutter, we've had CRH, there's been Ferguson.
And drug maker AstraZeneca, the most valuable British company, said it's planning a direct listing of regular shares in New York.
That is a real wake-up call for how urgently the government needs to do something about this.
There is reputational damage to the UK over the last decade or so. That's partly about Brexit, which has put off a lot of foreign investors. But it's also post-Brexit about the feeling that there is constant political chaos in the UK.
But them's the breaks.
There has been a mood music around the economy which has not been super positive for quite a long time. And that doesn't help attract capital into the UK.
That's reflected in more than just the stock market. Britain is particularly unattractive to bond investors right now. The 30-year yield on UK debt, which is what a bond is, was coming down until 2020, but it hit multi-decade highs this year. That makes it expensive for the government to borrow what it needs. It also gets money from tax, of course, but here too, investors are wary.
Stamp duty on shares in the UK is charged at 0.5% of each transaction, and that is the highest in any major market. Most major markets don't actually charge stamp duty at all.
Meanwhile, regulation is providing its own roadblocks.
The fact that so much management time is spent on regulation, managing compliance, and not actually managing the business is often cited as something that puts people off horribly.
The LSE is seen as one of the more stricter exchanges for governance. Now, in many ways, that's a strength, because it means that when you're listed on the London Stock Exchange, it means something.
But in other ways, it's just a reason not to bother when there are so many other options.
The private equity industry has soared, and so we've seen a lot of companies staying private, getting their money from different sources, either from debt or directly from private equity investors, in a way that they wouldn't have previously.
Even retail investors these days can pretty easily access private markets. So the perks of becoming a public company are not quite as clear-cut as they used to be.
So what's been done to change that? Let's start with executive pay.
The Investment Association has recently rewritten their guidelines for remuneration, And we are seeing FTSE 100 pay grow at a faster rate than S&P 500 pay for CEOs. And the gap does seem to be closing a little bit.
We are also really getting along with improving the regulatory environment and the listing environment for new companies coming to market. And we are talking very seriously across politics and across investment organizations about increasing the demand for UK shares by changing the dynamics inside UK tax wrappers, etc.
The London Stock Exchange kind of needs to get its swagger back. There's a lot of negativity around it, and that is massively driven by the data, by the facts, but also a few successful listings could really change the narrative.
And there are some. As the exchange's CEO pointed out in October, it's just that they don't always influence the rankings.
One of our biggest was the movement of a Greek company where they reincorporated in the UK, relisted their securities in London, and then came straight into the FTSE 100. They didn't need new cash, so they didn't have an IPO, and therefore they didn't count in those stats.
London still has a superb reputation as a financial hub. We have one of the biggest pools of institutional money in the world, and we have this infrastructure around what we do that is globally known and globally respected. We remain the biggest equity market in Europe, for example.
It is still the second biggest global financial centre next to New York on any kind of survey that you care to look at.
A few recent and upcoming IPOs give London some chances to prove itself. But for now, these are green shoots, when what London needs most, basically, are some massive trees.
If there is a multi-billion-dollar company that lists in London and the shares perform well, then suddenly you get a change in the narrative. And then suddenly bankers, companies, they are looking at the London Stock Exchange in a totally different way.